Well, if you look at Berkshire, you will find that it really doesn't do much of conventional asset allocation to categories. We are looking for opportunities, and we don't much care what category they're in. And we certainly don't want to have our search for opportunities governed by some predetermined artificial bunch of categories. In this sense, we're totally out of step with modern investment management, but we think they're wrong.
I don't build stock portfolios that always win because portfolios that always win don't exist. Anyone who tells you they have a system that always wins is either stupid or lying, probably both. What I build are portfolios that can survive my own stupidity and still compound over decades. That's a very different thing. The question itself reveals a fundamental misunderstanding about investing. People want certainty. They want a formula. They want me to tell them buy these 5 stocks in these percentages and you'll get rich. But investing doesn't work that way. If it did, everyone would be rich and no one would be. The edge in investing comes from being rational when others aren't, from having patience when others don't, from understanding businesses when others can't be bothered. None of that fits into a neat portfolio construction formula. Let me tell you how I actually think about building a portfolio, and I warn you in advance it's going to disappoint anyone looking for a system. I start with the assumption that I'm going to make mistakes. Lots of them. I'm going to buy things that go down. I'm going to miss things that go up. I'm going to be wrong about management, wrong about competition, wrong about economics. This is guaranteed. The only question is how much damage those mistakes will do. So the first principle of portfolio construction is don't let any single mistake kill you. That means position sizing. I don't care how confident you are, how much research you've done, how obvious the opportunity seems. You keep the position small enough that being completely wrong doesn't destroy you. For most people, that means no single stock should be more than 5 or 10% of the portfolio. Maybe 15% if you really know what you're doing and you've been doing this for decades. But I see people all the time who put 30 or 40% of their money into one stock because they're so sure, then they're wrong and they're devastated. That's not investing, that's gambling. The second principle is own things you understand. This sounds simple, but almost nobody follows it. They buy tech stocks they don't understand because tech is hot. They buy biotech because someone told them it's the future. They buy things with complicated business models because complicated feels sophisticated. All of that is stupid. If you can't explain how a company makes money to a reasonably intelligent 12-year-old, you shouldn't own it. I don't care how much it's gone up. I don't care how many smart people are buying it. If you don't understand it, you can't evaluate whether the price makes sense, which means you're just guessing. And guessing with your life savings is a bad idea. This eliminates a lot of opportunities. Good. You don't need a lot of opportunities. You need a few good ones that you actually understand. Warren and I have made most of our money from maybe a dozen decisions over 6 decades. We didn't need to understand everything. We just needed to understand a few things very well and wait for the right prices. The third principle, and this is where I diverge from most portfolio theory, is I don't believe in diversification for its own sake. The conventional wisdom is you should own dozens or hundreds of stocks to reduce risk. That's nonsense. If you own 100 stocks, you own 100 things you don't understand very well. That's not reducing risk. That's ensuring mediocrity. Diversification is a protection against ignorance. If you don't know what you're doing, own everything and you'll get average returns minus fees. Fine. But if you actually know what you're doing, if you've studied businesses carefully and found a few you understand that are selling cheap, concentrate your money in those few things. This requires confidence and competence. Most people have neither. They have false confidence based on no competence. So they concentrate and they get killed. But if you really do the work, if you really understand what you own, concentration makes sense. Berkshire has made essentially all of its money from maybe 10 or 15 positions over 60 years. Everything else was noise. Now, having said that, I wouldn't put more than 20 or 25% of my net worth in any single business, no matter how good I thought it was. Even when I'm very confident, I remember that I could be wrong. The world is complicated. Unexpected things happen. Management can turn out to be fraudulent or incompetent. Regulations can change. Technologies can disrupt. I want to be positioned so that even if I'm completely wrong about something, I survive and can redeploy the capital elsewhere. Let me talk about what goes into a portfolio. Most people should own index funds. Just broad market exposure, low cost, no drama. This is the right answer for 95% of people. They don't have the time, temperament, or skill to pick stocks, so they should own everything and get market returns. That's fine. Over decades, market returns compound into substantial wealth if you save aggressively and don't do anything stupid. But let's say you want to do more than that. You want to own individual stocks. Fine. Here's what you're looking for. First, businesses with durable competitive advantages. I'm talking about companies that have something their competitors can't easily replicate, a brand that people trust, a network effect where the product gets more valuable as more people use it. Regulatory barriers that keep competitors out, very low-cost production that others can't match, high switching costs that lock customers in. These advantages mean the business can generate high returns on capital for long periods without competition eroding those returns. Most businesses don't have these advantages. They're in competitive industries where everyone fights over thin margins. Those businesses might be fine at the right price, but they're not what I'm looking for in a portfolio core holding. I want businesses that can compound capital at high rates for decades. Second, competent and honest management. I cannot emphasize this enough. If management is dishonest or stupid, it doesn't matter how good the business is, they'll find a way to destroy value. Look at what management does with the cash the business generates. Do they reinvest it intelligently in the business? Do they make sensible acquisitions? Do they return it to shareholders when they can't reinvest it well? Or do they waste it on empire building, stupid acquisitions, excessive compensation, and share issuance that dilutes you? Management quality is hard to assess from the outside, but you can get clues from reading years of annual reports. Do they talk straight or do they spin? Do they admit mistakes or do they blame external factors for everything? Do they set reasonable expectations or do they overpromise? Do they treat shareholders like partners or like suckers to be milked? Pay attention to these things. Third, a reasonable price. This is where most people screw up. They find a wonderful business, they fall in love with it, and they pay any price to own it. That's stupid. Wonderful businesses at wonderful prices are still bad investments. You need a margin of safety. You need to buy at a price where even if you're somewhat wrong about the business quality, you probably don't lose money. What's a reasonable price? It depends on the business. For a truly great business with a long runway for growth, I might pay 20 or 25 times earnings. For a good but not great business, maybe 12 or 15 times. For a mediocre business in a tough industry, maybe 8 or 10 times. And even then I'd probably pass, because life's too short to own mediocre businesses. The price you pay determines your returns. If you pay too much, even for a great business, your returns will be poor. If you pay a reasonable price for a good business, your returns will be good. If you pay a cheap price for a decent business, your returns can be excellent. This is just math. The problem is that great businesses rarely sell cheap. Everyone knows they're great, so the price stays high. This means you spend most of your time waiting. You identify businesses you'd like to own, you track them, you wait for the price to become reasonable. Maybe it takes years, maybe it never happens. That's fine. Patience costs nothing. Let me tell you what doesn't go into a portfolio. No speculation, no options, no margin, no day trading, no hot tips, no story stocks with no earnings, no investments you don't understand, no investments where the only thesis is that someone else will pay more later. All of that is gambling dressed up as investing. I'm not saying you can't make money doing those things. Some people do, but most don't. And the ones who do often lose it all eventually because they confuse luck with skill. If you're building a portfolio for the long term, you eliminate all that noise. You own high-quality businesses at reasonable prices and you wait. That's it. Boring, simple, effective. Now let me address something that confuses people. How many stocks should you own? There's no magic number. It depends on how many good opportunities you can find, how much work you're willing to do to understand them, and how confident you are in your analysis. If I were starting from scratch today with a modest amount of capital, I'd probably own somewhere between 8 and 15 stocks. That's enough that no single mistake kills me, but few enough that I can actually know what I own. Each position would be somewhere between 5 and 15% of the portfolio, depending on my confidence level. I would not own stocks just to diversify. Every holding has to justify itself on its own merits. If I can only find 6 businesses I really understand and like at reasonable prices, I own 6. I don't buy 2 more mediocre ones just to hit some arbitrary diversification target. The quality of what you own matters far more than the quantity. I'd also keep cash. Not 5%, not 10%, maybe 20 or 30%. This horrifies modern portfolio theorists who think cash is a drag on returns. And it is, when stocks are cheap. But most of the time, stocks aren't cheap. Most of the time, the market is fairly valued or expensive. In those periods, cash optionality is more valuable than marginal equity exposure. Cash means you can act when opportunities appear. It means you're not forced to sell good businesses at bad times because you need liquidity. It means you sleep well at night because you're not fully invested at extended valuations. Warren and I have held substantial cash positions for years at times when we couldn't find enough attractive opportunities. People criticized us for it. Then markets would crack and we'd deploy the cash at crisis prices and make enormous returns. The cash wasn't a drag. It was ammunition. Let me talk about what you do after you build the portfolio. Mostly nothing. You sit there. You collect the dividends. You let the businesses compound. You read the annual reports to make sure nothing has changed, and you wait. This is psychologically very hard because it feels like you're not doing anything. You see the market moving, you see other stocks going up, you feel like you should be trading. Resist that feeling. Activity is the enemy of returns. Every time you trade, you pay commissions and taxes, and you make decisions that are probably wrong. The best investment decisions are often the ones where you bought something and then forgot about it for a decade. Of course, sometimes you do need to sell. If the business deteriorates, if management turns dishonest or incompetent, if the price gets so high that it's clearly overvalued, sell. But selling should be rare. If you're selling more than once every year or two, you're probably doing something wrong. You either bought the wrong things to begin with or you're panicking over short-term noise. The other thing you do is look for opportunities to add to positions you like when they get cheaper. If you own a business at $50 and it drops to $30 and nothing fundamental has changed, buy more. Most people do the opposite. They buy at 50, it drops to 30, they panic and sell. Then it goes to 100 and they wish they'd held on. Train yourself to buy when prices drop, not sell. This requires emotional discipline. You have to divorce your ego from the portfolio. When something you own goes down, you feel like you were wrong. You feel stupid. That feeling makes you want to sell and move on. But if the business hasn't changed, the price drop is an opportunity, not a problem. Some of my best returns have come from businesses that dropped 30 or 40% after I bought them, where I bought more at the lower price and then held for years as they compounded. I would have missed those returns if I'd sold when I felt stupid. Let me address rebalancing because people ask about it. Do you periodically sell winners to buy losers to keep your allocation balanced? No. That's stupid. Why would you sell your best businesses to buy more of your worst businesses? If something has gone up a lot and it's now overvalued, fine, sell it. But if it's gone up because it's a wonderful business compounding value and it's still reasonably priced, let it ride. The goal is not to maintain some predetermined allocation. The goal is to own good businesses at good prices. If one of those businesses becomes 50% of your portfolio because it's performed so well, congratulations. You did something right. Don't screw it up by selling to rebalance. Tax efficiency matters more than people realize. If you own businesses for decades, you compound value tax-free until you sell. The moment you sell, you pay capital gains tax, and you've permanently reduced your compounding base. This is a huge drag on returns. Compare someone who trades frequently and pays taxes every year to someone who buys and holds for decades. After 40 years, the buy and hold investor has vastly more wealth, even if the trading investor picked better stocks, because of the compounding advantage of deferring taxes. So tax considerations should heavily bias you toward holding, not selling. Obviously, if something is fundamentally broken, you sell despite the tax hit. But if it's just a question of whether to take profits, the tax tail should not wag the investment dog, but it should factor into your decision. Let me talk about something painful. Mistakes. You will make them. I've made dozens. I've bought businesses that turned out to be frauds. I've held businesses too long that I should have sold. I've sold businesses too early that went on to compound for decades. Every one of those mistakes cost me money, sometimes millions of dollars. The question is not how to avoid mistakes, because you can't. The question is how to minimize the damage from mistakes and how to learn from them so you don't repeat them. The position sizing I mentioned earlier is your first line of defense. If no single position can kill you, mistakes are survivable. The second line of defense is intellectual honesty. When you make a mistake, admit it. Don't rationalize. Don't make excuses. Don't hold on hoping it comes back. Admit you were wrong, take the loss, learn from it, move on. I've watched brilliant people compound their mistakes because they couldn't admit they were wrong. They held losing positions for years, or they averaged down on deteriorating businesses, or they blamed bad luck instead of bad judgment. All of that is poison. Admit mistakes quickly, learn from them, and do better next time. Over decades, if you're honest with yourself, you make fewer and smaller mistakes. Your judgment improves. You develop what Charlie Munger calls a lattice work of mental models that helps you see problems before they become disasters. But that only happens if you're brutally honest about your failures. Let me address market timing because people always ask about it. Should you try to buy when the market is low and sell when it's high? In theory, yes. In practice, it's almost impossible. I've lived through a dozen market cycles, and I've never successfully timed the market. Nobody I know has either, not consistently. What we can do occasionally is recognize when things are very cheap or very expensive. In the mid-1,970 seconds, stocks were obviously cheap. In the late 1,990 seconds, tech stocks were obviously expensive. Those extremes are recognizable. But most of the time, the market is somewhere in the middle and you can't tell if it's going to go up or down, so we don't try. We look for individual opportunities regardless of what the overall market is doing. Sometimes we find a lot, sometimes we find none. But we're not making that determination based on market levels. We're making it based on whether we can find specific businesses we understand at prices we like. If the market crashes and takes everything down with it, we buy aggressively. If the market runs up and nothing looks attractive, we hold cash and wait. But we're not predicting the market. We're responding to the opportunities it presents. This is a subtle but important distinction. Market prediction is guessing about the future. Opportunity recognition is evaluating the present. The first is impossible. The second is learnable. Let me talk about what happens during bear markets, because this is where most investors get destroyed. Markets drop 30, 40, 50%. Everything you own is down. You're losing money every day. The news is terrible. Everyone is predicting doom. Your friends are selling. Your relatives are asking why you haven't sold. It's psychologically brutal. This is when you need to think clearly. If you own good businesses that you bought at reasonable prices, their long-term value hasn't changed just because the stock price went down. The businesses are still generating cash. They still have their competitive advantages. They'll still be around in 10 years. The price drop is noise, not signal. In fact, if you have cash, this is when you buy more. When everyone is panicking, when the headlines are screaming, when your gut is telling you to sell, that's when you buy. This is unnatural. It goes against every instinct. But it's how you make money in investing. You buy when others are selling in panic. You sell when others are buying in euphoria. The problem is that in the moment, you feel the same panic everyone else feels. You're not immune to psychology just because you know you're supposed to be greedy when others are fearful. Your brain is screaming at you to protect yourself, to get out, to stop the pain. Overcoming that requires preparation. Before the bear market happens, you need to have made decisions about what you'll do. Write them down. If the market drops 30% and nothing fundamental has changed in my businesses, I will hold and I will invest new money. Having that written commitment helps you do the right thing when your emotions are screaming at you to do the wrong thing. The investors who get rich are the ones who stay rational during market panics. Everyone else gets poor by selling at the bottom. Let me address something about portfolio construction that most people get wrong. They think about their portfolio in isolation. They forget that they have other assets. If you're young and you have a job, your future earning power is an asset, probably your largest asset. That asset is like a bond. It generates steady income. Given that, your investment portfolio can be entirely in stocks because you have the bond component covered by your human capital. But if you're retired and you need your portfolio to generate income to live on, you need a different structure. You can't afford to have everything in stocks because a market crash at the wrong time could force you to sell at terrible prices. You need some stable income sources, some bonds, maybe some dividend-paying stocks, some cash. The portfolio structure should match your life situation. A 25-year-old with a good job and 40 years until retirement should have a very different portfolio than a 70-year-old retiree. But most people don't think about this. They read that Buffett recommends index funds, so they buy index funds regardless of whether that matches their situation. Or they read that you should own bonds for stability, so they buy bonds even though they're 30 years old and don't need stability. Think about your total financial picture, not just your investment account. Another thing people get wrong is thinking about absolute returns instead of risk-adjusted returns. If I told you I made 15% last year, that sounds good. But if I took huge risks to make that 15%, if I was leveraged, if I was concentrated in speculative stocks, if I could have just as easily lost 50%, then the 15% isn't impressive. It's reckless. Compare that to someone who made 10% by owning a diversified portfolio of quality businesses with no leverage and minimal downside risk. The 10% is more impressive than the 15% because it was achieved without taking stupid risks. Over time, the person taking smart risks compounds wealth steadily. The person taking stupid risks eventually blows up. Returns are meaningless without context about the risks taken to achieve them. This is why I focus on downside protection. What's the worst that can happen? If I buy a business, what's the scenario where I lose a lot of money? Is management dishonest? Could regulation wipe out the business model? Could technology disrupt it? Could a competitor destroy its advantages? If I can't think of scenarios where I lose big, or if those scenarios are very unlikely, then I'll invest. But if there are plausible scenarios where I get destroyed, I pass, regardless of the upside. Avoiding big losses is more important than achieving big gains. The math of compounding works this way. If you lose 50%, you need 100% gain to get back to even. It's asymmetric. Losses hurt more than gains help. So your primary job is to avoid big losses, not to chase big gains. Let me talk about something uncomfortable. Luck. A huge portion of investment returns is luck. You can do everything right and lose money because something unpredictable happened. You can do everything wrong and make money because you got lucky. Most people don't want to hear this. They want to believe that their gains are due to skill and their losses are due to bad luck. But the truth is messier. Skill and luck are both factors, and it's very hard to disentangle them. What I've learned is to focus on process, not outcomes. Did I do the work? Did I understand the business? Did I buy at a reasonable price? Did I stay rational? If yes, then regardless of the outcome, I made a good decision. Sometimes good decisions lead to bad outcomes because of bad luck. That's fine. Over time, good process leads to good results. But any single outcome can be misleading. This is why you can't learn much from short-term results. Someone makes 50% in a year and they think they're a genius. Maybe they are, or maybe they just got lucky. You can't tell from 1 year. You need to watch their results over a decade or longer. Only then can you distinguish skill from luck. And even then, it's hard. The best investors I know are humble about this. They know they've been lucky, in addition to being skilled. The worst investors I know are arrogant. They attribute everything to skill and nothing to luck. That arrogance leads them to take bigger and bigger risks until they blow up. Stay humble. Admit when you were lucky. That humility will save you from overconfidence, which is the most expensive psychological trait in investing. Let me end with something important. The portfolio is not the point. The portfolio is a means to an end. The end is financial security and freedom. The end is not having to worry about money. The end is being able to do what you want with your time. If you get so focused on optimizing the portfolio that you make yourself miserable, that you obsess over every price movement, that you lose sleep over your holdings, you've lost the plot. Build a portfolio you can live with. Build something simple enough that you understand it completely, diversified enough that you can sleep at night, concentrated enough that you have a chance of beating the market, and then ignore it most of the time. Check in quarterly to read annual reports and make sure nothing has fundamentally changed. Otherwise, live your life. The portfolio should serve you, not enslave you. If it's causing stress, you've built it wrong. Simplify, reduce risk, accept lower returns in exchange for peace of mind. That's a perfectly rational trade-off. I'd rather have a calm life with decent returns than a stressed life with slightly better returns. The difference in wealth over decades is trivial compared to the difference in quality of life. This is something I wish more people understood. Building wealth is good, but it's not the only thing that matters. Build wealth in a way that makes your life better, not worse.